White House weighs scrapping SEC rule that forces best stock prices. The Trump administration is weighing whether to repeal a foundational SEC market structure rule that requires brokers to route customer orders to the venue offering the best available price, according to a Bloomberg report cited by Cointelegraph on May 19, 2026. The rule in question is part of Regulation NMS, the framework that has governed U.S. equity market routing since 2005. Its order protection provisions are designed to stop brokers from executing trades at inferior prices when a better quote exists somewhere else on the national market system. The rule at stake, Reg NMS Rule 611, often called the Order Protection Rule, requires trading centers to establish policies that prevent trade-throughs, meaning executions at prices worse than the best publicly displayed quote. Combined with Rule 605 and 606 disclosures, this is the legal backbone that turns best execution from a fiduciary platitude into an enforceable obligation. The White House review, per Bloomberg, is examining whether those protections still serve investors or whether they have calcified into a barrier that locks volume into a small set of incumbent venues. The Bloomberg piece frames it as part of a wider deregulatory push to revisit Obama-era and Bush-era market structure rules. If the rule is scrapped, brokers would gain more discretion over where they send orders. Critics of repeal argue that retail flow, already largely internalized by wholesalers like Citadel Securities and Virtu, could be routed to venues that pay the highest rebate rather than offer the tightest spread. Timing lands amid broader SEC rollback. The review surfaces in the same month that the SEC has been rolling back enforcement-era policies. Earlier this week, the agency rescinded its decades-old gag rule on enforcement settlements, freeing defendants to publicly contest the SEC's factual claims after settling cases. The combined picture is a measurable pullback in the SEC's market conduct posture under the current administration. Crypto market participants should track the review closely. The Clarity Act, currently moving through the Senate floor under heavy bank lobbying pressure, leans on parallel concepts of broker duty and venue obligation when it defines how digital asset intermediaries must handle customer orders. Whatever framework replaces or modifies Reg NMS for equities will set the rhetorical baseline for how the same questions are answered for crypto venues. A weaker best execution standard in equities makes it politically harder to impose a stricter one on crypto exchanges and broker-dealers handling tokenized assets. Market reaction. So far, equity markets had not opened by the time the Bloomberg report circulated late Sunday U.S. time. Crypto markets were unmoved by the headline itself. Bitcoin traded at $76,630 as of May 19, 2026, down 0.7% on the day, and Ether sat at $2,023 with a 0.1% gain. The CoinMarketCap Fear and Greed Index registered 39, a fear reading. The lack of immediate crypto reaction tracks. This is a slow-burn regulatory story, not a flow event. Its consequences play out over months of rulemaking, not in a 24-hour candle. Second-order effects to watch. A repeal would have practical consequences across the trading stack. Retail brokers that already route flow to wholesalers for payment for order flow would face fewer constraints on price disclosure. Dark pools and ATSs would compete differently for institutional volume if the trade-through prohibition softened, and exchanges that have built premium products around guaranteed best price execution would lose a structural moat. For crypto-native readers, the more direct relevance is in how SEC commissioners and staff frame any successor regime. If best execution is redefined as a flexible standard rather than a hard routing rule, expect the same language to migrate into how the SEC describes its expectations of crypto trading platforms registered under any future framework.